Welcome to the Corporate Venturing Insider Series, where I interview top practitioners in the CVC world and learn with you the best practices and golden nuggets that they have accumulated over their career. In this episode, we will be learning from Malin Carlström, Head of Ventures at ABB Technology Ventures. Malin, could you take a few minutes to share your story and how you got to where you are today?
Thank you so much for this opportunity. As mentioned previously, my background is with financial venture capital, and that's really where I started my career. So I'm an engineer by design. I was very much into the environmental issues already back in the 90s. So that's what I wanted to study. So I took a Bachelor of Science in Energy and Environmental Technology, where we actually programmed a website in 1998 where you could calculate the carbon footprint. So that was like 22 years ago, something like that. And then I took a Master of Science and an MBA. And after a management trainee with a large Swedish bank, who was the only big bank that was conducting venture capital operations, I think the venture is even more about technology and technology understanding than finance. And the combination of the two really fitted my interest and background and knowledge. So my entire career, I've been in this industry. It's been, tremendously satisfying and interesting and hard. I've invested across a number of industries. It's consumer-based products. It's B2B2C. It's B2B. It's been clean tech, fintech, legal tech, music tech. Such big brand names. Early investor in Fishbrain, the largest Anglo community in the world. Soundtrap, which was acquired by Spotify. And then a lot of clean tech stories as well, good and bad. And then I'm with ABB and my first real corporate venture capital role since 3.5 years back. I think in general, it's more common that you perhaps move from CVC into financial venture. And I did the opposite. So I started out with the financial VC industry, and it was more by chance than really a set strategy that took me into ABB.
Thank you, Malin. I think it's really nice journey you took, and there's a thread I can see about the engineering and the technology. Tell me how you work on making sure that this innovation that you're exposed to could influence that one engineer in ABB that could then be empowered to actually create this transformation. Can you talk about some of the best practices, but also maybe the pitfalls of having this grassroots initiative? What worked? What is something you would say to this audience? Watch out for these parts.
There are very good books and reports on what constitutes best practice in CVC. One of the major things is where does it belong in the organization? So when you see successful CVC teams and strategies, they usually lie under the CEO or the strategy officer and not under the CTO. It's not a technically something R&D correlated type business. It's not. So that's the first one. Where in the organization do you lie? And then I think it's important to have the right mandate and the commitment over time. It's never a sprint. This is a marathon. And we're going to lose money and we're going to gain money. We're going to have companies that don't succeed in generating strategic value. And we're going to have those that will. And it's going to take time to single out which are the winners and which are not. So I think a commitment in time is super important. And then you need to have the horizon focus more aligned with the startup than with a quarterly reporting type public company, right? Especially then when it's very tech driven, B2B focused or industrial. It takes time. And then, of course, with the sizable amount of capital committed, because also building a successful portfolio, and also if you look at financial return, it's a numbers game, right? So you're going to need your number of companies, whether it's 15, 20, 25. So those are some of the key things. And also, I believe that if you don't have experience in VC as a corporation, hire people who have, whether it's financial VC or CVC from somewhere else, but it's very particular. And it's not the people you usually find perhaps in your organization. And then you can complete the team with people from within, with technical background or sales background or whatever, right?
And what would you say is a good golden ratio between external people that bring skills you may not have internally and internal teams?
I don't have a golden ratio on that one. I think it's always a bit dangerous, whether you're talking about competence or minority representatives or whatever, to have one, because that's more of an odd one out than actually getting the experience of you put forward. So I think at least two. But then it depends on how big the team is and who is on and whatever you find the experience from inside.
I like your analogy of marathon.
We are usually evergreen structures. Sometimes we're not, but we usually are. And if you have the long-term commitment, that's a very strong sales argument, especially to serial entrepreneurs who maybe had the experience of getting funding from a fund that was later stage and where you had to liquidate quite soon. And the trap that they puts you in as a founder, as an entrepreneur.
So Malin, I'm going to triple click on this one because we never touched on the concept of evergreen fund in the last 17 interviews. Clearly, I understand the long-term commitment, and this is a really nice discipline. What do you think are the reasons why someone would want to do an evergreen fund versus a structured fund 1, fund 2, fund 3?
We invest directly from the balance sheet. So we don't have a standalone fund structure, and people working with venture are just employed by ABB. So that's a setup that has been since we started 2000. I think it's very common practice, but then some people choose to have a standalone fund with perhaps more of a standalone also investment mandate, an investment committee. And then it's more similar to the financial VC side. The advantages of the standalone fund is that it's hard to divest because the money is kept, right? That might be easier with the balance sheet operations because you can from one year to another say, no, we're not going to do this anymore. But from an investment perspective, with my previous fund, which was set up as an evergreen and a foundation, the staying power you have can be very valuable. So that fund, for instance, they held it for 14 years, which would never happen in a vintage fund because you have to get out. And I saw a number on financial VC structures. I think it was like 5% who was liquidated after the 10 years, not more. So it takes longer time than you think, also in consumer products, but especially when you have industrial applications as we do.
Can you talk us through how you define the KPIs? Is it just before the investment decision? Is it after the investment decisions? Is it during the due diligence? How do you define these KPIs and why do you make them so different per investment?
So there is no set library of KPIs. We don't have that. But I've been looking into this quite a bit and can segment it into qualitative and quantitative. And so the quantitative ones are, of course, easiest. So you can have your IRR or your multiple or your revenue generation or whatever. And then you have the qualitative ones, and those are harder. It can be about knowledge increase, maybe benchmark, a more agile way of working, etc., etc. And I think that each case that we bring and that we invest in, we do have an idea of what's the value that we want to create. And we define that through an engagement plan and a rationale. So where is ABB now? What's our need now? Or what's our need in 5 or 10 years? What can this startup and the technology itself help us do? And as we said before, that could be sales or market access or customer insights or whatever. But it's very much on a case-by-case basis. And the final reporting is not as much in a table format with KPIs as much as showing evidence of this is what we've been doing, this is the results, it worked out, it's not working out, such.
Over time, maybe the mothership start changing strategy or divest, or the startups might pivot, and therefore what you expected to deliver is very different. How do you track this, and how do you message these changes over time?
So first, that's absolutely fine. Everyone must agree that it's fine, right? It's fine. We can lose our money. We can gain absolutely zero strategic value. That has to be fine. We don't want to cage startups. They are their own companies, and ABB is our own. We're not talking about the pre-acquisition type of operations here. It's two standalone companies, and people leave, people join. We do divest, we sell or spin off, or we initiate new segments in new markets, and so does the startup. And that's absolutely fine. We're just saying that at the time of the investment, a mutual engagement plan has to be in place. Now, it's not a legally binding document, but it's a strategic ownership agenda, as you might also have a financial ownership agenda, and you agree on it. And you want to have it in writing because it's so easy to misinterpret each other. And you say, oh, we agreed on this. So that's very important. And we see as we go. And that's also a part of the strategic value, I think, that ABB can gain from interacting with startups. That we find out that this market is really hard and the profitability is really low. Okay, fine. Lesson learned, we don't enter. Or it's the opposite, that this company, they were right. So it's going to be robotics as a service, or it's going to be graphene that changes everything that we do with the electricity needing plastics. And that's fine. I know our former CTO, we did a horrible investment in a photovoltaics company. And he said it was the best investment because one of our competitors ran off and bought a PV company for billions. And we just did a small VC investment and it showed out to be a disaster. So lesson learned. So dipping our toes in that water. And also as a CVC, you do have the power to make your investment a winning horse, right? Because the promise that we bring is that our dollar is worth more than a financial dollar. If we can help startups with reducing time to market, reducing risks of failed product development, if we can get them access to our researchers, to our salespeople, everything around this that helps them speed up faster and do fewer mistakes, because that's what venture money is for, right? Affording to hire the wrong people and the right people, making the mistakes and growing. If we can help them in doing that in a smarter way, then I think we are adding the value that we promise. And that's also the hard part, the engagement going forward. But it's also very enticing. And that's what I'm saying with the win-win or no situation. One of my favorite reality is of innovation disruption. And that concept happens all the time for every company, all the time. And ABB is up here. We have these great technologies. We have an attractive customer segment. We try getting the margins higher with whistles and bells. And then comes someone from underneath, adapting the new technologies, having a factor 10 on decreasing costs, and that just eats it away into less attractive market segments. And sooner or later, they are there against you. And that's what I think corporations need to realize. And offsetting that risk through the startups, because they actually constitute the threat. So having them as your ally instead and trying to gain the values from experience in a very nice ecosystem type of reality, I think that's very important. So not looking at the startup as a competitor, because yes, there are companies that can create their own ecosystem like Apple or maybe Google, but ABB, most of us won't. So how do we then make sure that we are relevant in the next decade and the decade after that and so forth. And then I think you have to be in an ecosystem of winners. That's the key. So you have to bring stuff to the table and you have to have the winning forces around you. They are not your enemies, they're your allies.
That's a really good way to explain it. And in a way, it touched also on what you said about the R&D, who have to also make bets, but they can't go too high in risk either. And therefore, you could see the R&D and the corporate VC as real allies. Corporate VCs can make way more bets, less costly in many more places, where the risk is much higher than the R&D can afford.
There is research being done also on this golden ratio. It's more about D than R, I would say. It's heavier on product development than actual research in general. And so for the moonshots, how do you get access to that? For ABB, we have so much requirements on cybersecurity and things really have to work 24/7. So we need, of course, to operate in a safe zone in a way, but it's also critical that we move forward with a certain speed. So then we need to partner up. The risk for us could be that we divert with some half percentage in the gross margin, but the risk for the entrepreneur is that he's going to lose his house, his wife, his dog, and he's fine with that.
You talk about partnerships, so let's talk about syndicate. And here I want to ask about your general approach to syndicate, but also what happens when actually one of your KPI is a potential acquisition of that startup, because that creates a different dynamic with a syndicate potentially.
We almost always co-invest with other players. We co-invest with the Eaton, Siemens, and Schneider, but we also do so with financial players. So we're all over the place. We think that having a dynamic of more parties than one with the deeper pockets in the boardroom makes a lot of sense. And it's better for everyone involved. And it's also a way of not labeling the company an ABB company. And it's always about trust. I think everyone is in a good mood before an investment is done. Everyone is showing off their good sides. But then comes the work during the marathon. And you need to be able to have a constructive cooperation, even though it's going to be hard times. And then if you feel that the negotiation was not a win-win, but a win even from start, it's not a good starting point. So everyone needs to be dissatisfied on the same level when they are signing the agreements.
Now, many people ask these questions, are you strategic or are you financial? I hate that question, so I'm not going to ask that question, but how do you reconcile the strategic imperatives that you want to address with a financial discipline of good VC type returns?
We are first and foremost a strategic investor. I would also say that some investments are more strategic than others. So there is the compartments here. Take the graphene company. ABB is never going to be a material science company. So for us, that is not as core. So we are less of the strategic investor. So we do a lot of collaborations with them, but it's not very close to the core. Compare that to if you're looking at grid management companies or robotics companies and such, which are more closer, then it gets a bit more sensitive. It has to be managed in a very good way. So we need to tick that box. We need to tick the strategic box first, which is usually what takes time. That's why it's very nice to have hackathon events, collaboration units, getting the feel for one another, getting into projects, maybe going to market together, whatever it is, before going into the investment. And sometimes ABB are a bit slow in finding that alignment. So my recommendation for startups that are looking for funding for us, have a good time before the actual fundraising is started, because we do need some time to find the ambassadors and such. And then we, from the venture team, also tick the financial box. I always like to have commercially sound terms. I always negotiate. I always want to see a sound financial investment.
How quick are you to make investment decisions?
As I said, it's a strategic part first that takes time. And then after that, it's as fast as any other investor. So the due diligence process, the negotiation can take. I'm actually looking into one company now, and I think 3 weeks, but then it can take a year as well. If you have the POC, then you have technology, and you need to create and try it out and such.
Very nice. We're getting to the
Yeah.
top of the hour, but I want to ask a question about something you said, which was very interesting. You said you need to have specialists in growing company in the team. How do you find these people? Are you looking at people who did startups before, or are you looking at people who were on board of companies that helped the company grow and be successful? What are you looking for in this specialist in growing companies?
This is my belief. I know that there are some who say that an investment team should be consisting of entrepreneurs because they have the experience with growing companies, or you want people who are more of investor experience, financial analyst, and that type of. And I believe that as an entrepreneur, you have a very specific personality. And I think as an investor, especially, like, I'm very risk averse. I don't like risk, but I do see opportunities. And when you're trying to hedge stuff, you get very good at constructing the good investment hypothesis and identifying the opportunities because you have the devil's advocate. So you have control of stuff. And I think that the entrepreneur has to be the star of his own company or her own company. So I think, yes, sometimes you have entrepreneurs in investment teams, but they should not just be entrepreneurs, because I think you need the different types of personalities. And I don't want to have an investor who challenges all the time from his perspective or her perspective, but I want someone to support. And from an investment perspective, with our insights.
Very nice. So my last question is something you care about and maybe inspiring for everyone to listen to is, what do you think corporate venturing should do better to ensure that we have as much positive impact for the environment?
I think it's a numbers game. It's a lot of money out there. I think we need more because the institutional capital is now flowing to the sector, but there are not enough companies. And that's why you have this difference. So I think that corporates really have the power. We do have the money and we do have the channels. We have the market insights. We have the installation capacity. So I would say just do even more of what we're doing and realize the importance of time and speed. Elon Musk said, yeah, of course, if you work 100 hours per week instead of 40 hours per week, you get more done, right? I'm not saying that, but I'm saying that if we add hours, people, and money, we can make things happen faster. And with the muscles of the corporations, that we will speed it up. Then you need to understand that there is no really high risk in venture. The largest risk is not doing anything at all. That's the risk.
Nice. Malin, it's a really good way to end the interview. Thank you so much.
Thank you.